Welcome to the Oregon Small Woodlands Association Forestry Taxation Series. This is our first episode in a 7-part series focusing on taxes and forestry and how it relates to you and your properties. Today, Clint Bentz will cover an overview of timber taxation and deducting causality losses. So before he gets started, let me give you a little intro. Clint Bentz is a CPA with 3 decades of experience helping family forest landowners and their tax advisors to understand the complexities of the income and estate tax code relating to forestry. Clint retired from the CPA firm Bolt, Carlisle & Smith in 2018 and founded Business Navigators LLC, a family business consulting firm specializing in estate and succession planning for family-owned farms and timberlands. Clint has been very involved with the Oregon Small Woodlands Association and the American Tree Farm System. In 2002, Clint and his parents were honored by becoming the National Outstanding Tree Farmers of the Year. He's been very involved with the Oregon Small Woodlands Association, and in 2005, he was awarded the Riggin Slinger Award. Without further ado, Clint, it's all yours.
Thanks, Jeremy, and welcome everybody. So I'm going to go ahead and share my screen here so we can see the presentation.
I forgot to mention one thing.
Is that up now, Jeremy?
It looks good, and I just want to comment that if anyone has any questions, there is a chat box and a Q&A box, and we're happy to take your questions throughout. So you don't forget. Please feel free to post them in there as they come to you. Thank you.
Great, and I think there, Mike Clossy sent out a handout earlier today, so hopefully all of you have received that and maybe had a chance to print it out or have it up on a screen as we go through the presentation today. So we put this seminar together. It's called a Timber Taxation for Forest Landowners. Pretty simple. We're going to have 7 sessions altogether. So and they're kind of spread out. So today we're going to just look at an overview of timber taxation, some of the special rules around timber taxation. And because of the fire and the timeliness here, we're also going to talk about deducting casualty losses. Many of the small woodland owners lost some timber here in the Labor Day fire, and so we'll talk about how those losses get deducted. On March 23rd, we'll talk about classification. So how you're classified determines how you're taxed. So are you classified as an investor, as a passive business, as an active business, as a farm, or as a hobby? So we'll go through all those rules and we'll see what these different classifications mean, and because they are fact-based, it's based on your activity and your intent. And so we'll look about that and how taxation changes depending on your classification. On March 30th, we're going to talk about income. When we sell trees, when we sell logs, sell standing timber, sell the property. We'll look at all those different things when we have income, sell an easement on the property, all those things. So we'll look at all the different kinds of income that come off the property. April 13, we'll talk about expenses and the expenses that are deductible depending on the type of entity that you are. On April 27, we're going to talk about capital expenditures. So when we buy equipment and also when we repair equipment, how that works. And so April 27 will be about, and then also we'll talk about roads and other things like that. On May 11, we'll look at the form of business. So I know there's lots of questions about LLCs and corporations and sole proprietorships. And so we'll look at all those different forms of businesses, partnerships. And then we have just kind of some other miscellaneous tax issues that we'll put into the May 11th session. And then the last one on May 25th, we'll look at Oregon's property and harvest tax programs. I'm hoping that by May 25th that our property and harvest tax programs won't have changed too much. As many of you know, the legislature is looking to make some changes to those systems this year to try to raise some more taxes. And so, but we'll look at our system, either the current system we have now or whatever the new law has been proposed or has been enacted by then. So today we're going to talk for about an hour, and then we'll have some time for questions and answers afterwards. So if you have questions as we're going along, go ahead and put them into the chat box. Tammy Cushing and Jeremy. So Tammy's my partner in this from Oregon State. So she's going to be kind of moderating the chat room. If there's some questions, she'll probably be answering some of them as we go. And then we'll have some time at the end where maybe larger questions or questions, maybe 2 or 3 of you have a question. She'll maybe put those together and then we'll deal with them at the end. So if you have questions, go ahead and put them in the chat room. So today we're going to talk about timber terminology, look at some Oregon forest facts and figures. OFRI just recently updated their document on this. And then we'll look at an overview of all the special tax provisions and rules for forestry. And that's 263A for capitalization. There's a number of code provisions on the sale of assets, 1221, 1231, 631A, 631B. We'll look at the deductibility reforestation costs under section 194, and we'll look at the Form T. So those are kind of the unique things about timber. We'll introduce them today. We will talk about them more in depth when we come to the income sections or the expense sections, but we want to introduce them to you today. I'm including code sections in this because I wanted to have something not only for you, but also for your tax professionals. So I know many woodland owners do their own taxes. So we wanted to have enough information for you so that you could do your own taxes if you want to. But also, since many professionals don't do enough of this to be good at it, I also wanted to have a resource that you could take to your tax professionals, have an informed conversation with them, and maybe leave something behind so that they can do a better job helping you. And then finally, we'll finish up talking about the 2020 wildfire and wind casualty losses as a result of the Labor Day fire. So we'll start off talking about some timber terminology. So I find this is a great, and for those of you who have your materials open, it's on page 3. As with many things, timber has its own vocabulary, and it's important that we understand what these terms mean, and it's important that our professionals understand what these terms mean. So stumpage is one of the bigger terms. So stumpage basically means standing timber that's still attached to its stump. So when we talk about stumpage or we talk about timber, we're basically talking about trees that are still alive, that are still standing, attached to their stumps, which are attached to the ground. That's different than a log, right? So we turn timber into logs by putting a power saw through it, and it tips over and it becomes a log. There's a real difference in the property. While the timber is standing, it's considered real property. It's attached to the real property and it's considered real property. When we cut it and turn it into a log, we've changed its character into personal property. The taxation changes depending on if we're selling standing timber or we're selling cut logs. Because in one case, we're selling something that in effect is real property. The other one, we're selling personal property. And so we have a different tax thing. And so it's a really important distinction to understand, and it drives a lot of the tax code. Scaling and cruising. So we know the process of scaling and cruising is measuring. So scaling is measuring a cut log. And we try to figure out, based on the log, how many board feet of timber, of lumber, how many board feet of lumber can be cut out of that log. And not only the amount, but the quality. So how many knots, the rings per inch, all those things that determine the quality. So scaling is when we do that for a load of logs or for an individual log. Cruising, we're doing the same thing, but we're doing it out in the woods. So when we cruise a stand of timber, we're actually looking at standing trees and trying to determine how much lumber is in those trees and what quality of lumber is it. So when we're trying to determine both the value and for management purposes when we're doing the cruising. And generally when we're doing cruising, we're doing a sampling method where we're only looking at certain plots that are lined out that are representative of the stand as a whole. And so when we're doing cruising, again, we're doing that. We're not generally looking at every tree, but we're looking at representative trees across the stand. A board foot is just that. It's how we measure lumber. So board foot is a board 1 foot long, 1 foot wide, and 1 inch thick. So 1 foot by 1 foot by 1 inch. It's basically 144 cubic inches. So anything, so we have 1 foot by 2 inches by 6 inches is the same, is also 1 board foot. So it's any combination that gets us to 144 cubic inches. And so that's the standard measurement of that's used for purchasing logs and also for inventorying and selling lumber. We all do that all by the board foot. The Scrivener scale, decimal C, is the method that we use here in Western Oregon for computing the amount of board feet that lumber is of lumber that is contained in a log. This method was developed in 1846 by a guy named J.M. Scrivener, which is why we call it the Scrivener method. So it's a really old system. It was based on the average diameter of the log at its small end. So we look at the widest and the widest area and the narrowest area, and we take an average of those two, or the diameter. We measure the small end, and it's based on the technology in 1846, which was a 1/4 inch of kerf of cut. You'd lose a 1/4 inch basically because the saw was that wide. We'd lose a 1/4 inch every time we did a cut, and there was no ability to get anything out of the taper in the tree. So basically we know a tree gets bigger or smaller as it gets bigger as you get to the bottom, smaller as it goes to the top. And so that taper back in 1846 was all thrown away. They couldn't do anything with it. So that's why it's measured from the small end. That was considered the scaling cylinder. We know today most sawmills can get at least twice the amount of board feet out of a log that we actually measure with the Scrivener scale. So if we would scale a log, and it would say we had 500 board feet in that log, generally when it ran through the mill would get 1,000 board feet of lumber out of that log. You say, well, that's not really fair, is it? Except that basically it's all figured in to the things. That's why we can sell our timber to the mill, or logs, at $700 1,000 board foot. They're selling the lumber at $500 per 1,000 board foot, and they're making money. And so it's because of the gain that they have when with using modern technology. The grades, logs are graded, lumber is graded. It's based on the number of rings, the number of knots, the size of the knots, and how far apart they are. And so all those things determine, so we have things called, two sawmill grade, 3 sawmill grade, peeler grades, all these different special mill grades, all these different grades that we have for logs. And those are measurements of the quality of the lumber that is produced out of the log. The final thing there is a site class. And the site class is a measurement of the productivity of the soil. And so trees, they're growing things, and actually their height, how tall a tree will grow, is a function of the soil that the tree grows in, and the soil and the average rainfall and all that that comes into this area. And also elevation has something to do with that too, but it's primarily the soils. And so the entire state, or at least the western half of the state, is classified into these site classes. And basically the site class is the measurement of how tall a Douglas fir tree will grow in 50 years or 100 years based on the productivity of the soil. And so, and the site class drives valuation for the timberland. The higher the site, the more trees it'll grow, the faster the trees grow, the taller they grow, and so the land is more valuable. And for our property tax system, the land is taxed at the higher site classes are taxed at a higher value than the lower site classes are. All right, so let's look at some Forex facts and figures. We know that nearly half of Oregon is forest land, about 30 million acres. What a lot of people don't know is that that number, 30 million acres, has been relatively constant. You can go back the last 100 years, you can go back the last 400 years. And basically we've had about 30 million acres of timber that has been forested. So here's a little chart showing that. It goes up and down a little bit. But if we look back to 1920, we basically have the same amount of forest land that we do today. So the forest land acreage, acres in forest land. So Oregon basically has not lost a lot of land to development. I've got two charts here on the left. So there's 30 million acres of forest. The question is, who owns it? And so if we start at the top and move around to the right, that big area there, that's the federal government. So the federal government owns about 60% of all the forest land in Oregon. The next little group is the state of Oregon. They own about 3% of the forest land. That next itty bitty part is the counties and municipal governments, the counties and cities. They own a little chunk. And then the big gray area, those are the large private landowners, those that have more than 5,000 acres. The next block of the lighter gray is the small woodland owners, people that own less than 5,000 acres. So that's us. We own about 22, well, it's about 12% of all the forest land in Oregon is owned by small woodland owners. And then that last little chunk, the dark blue, are the tribes. So that's how the ownership is broken out. A private ownership, small landowners and large landowners, is about 58%, no, 36% of the land. So we own about a little over a third is owned privately. The rest of it's owned basically by the government. On the right-hand side, we see the productivity. So again, starting on the top, that dark blue, those are the coast range. That's our highest productivity land. So it shows how much of our land is there. The next area is the valley. So we look at the coast range, and the valley is almost half. The valley is medium productivity land. Then the big kind of greenish area, that's Eastern Oregon. That's fairly low productivity. Over in Eastern Oregon, those trees don't grow nearly as fast as they do here in Western Oregon because they don't have the rainfall. It's also quite a bit higher elevation than the west is. Then that final area are the high mountain areas, which are very, very slow growing or almost no growth at all. Many people say that you know, if you go back east, they think we've laid the chainsaw to the roots of the last tree in Oregon, and that's just not true. You see the little chunk or the circular part on the right, that shows the total harvest or the total growth. So over the last 10 years, on average, every year there's about 2.8 2,840 million cubic feet. So it's basically a little 2.8 billion cubic feet of growth that grows in the forest. Of that, about 39%, the green, is harvested. 25%, the red, is lost to fire, insects, and disease. And the other 36% is still in the forest. So we're not, we're cutting less than 40% of the growth of our forests and harvest. And we look at it by ownership. The federal lands are only harvesting about 8% of their growth. They're losing about 36% of the annual growth to fire, insects, and disease. And then every year, about a little over half, 56% of the growth remains in the forest. That's part of the reason why we have such huge forest health issues in the federal forest, because they are getting overgrown and stressed because the stocking is just too high. We look in the state forests, again, 56% of the growth there was harvested, 18% was lost to mortality, and 26% is still in the forest. And then on private ownerships, we're about 77% of the growth gets harvested, 11% is lost to insects and disease and fire, and then 12% is still in the forest. So even on the private ownerships, we're only, it's less than 90% between harvest and mortality that is going. So we're adding about 12% annually to the stock in even on the private forests. We also look at jobs. So forestry-related employment, we have over 61,000 jobs in Oregon. The average wage is in 2019 was over $56,000, which is more than the average for all Oregon employment. So it's above average wages. It's 3% of the total jobs in Oregon are in the forest sector. But in rural counties, many counties, the forestry jobs are more than 10% of the total. And this chart here kind of shows in the various counties. The blue is the average annual wage, and the forest sector wages are the total, and you can see the percentage difference. So like in Clatsop County, forest jobs are pay 85% more than the average. In Grant County, it's 28% more. So so they're good paying jobs, and a major source of employment in rural counties. Finally, we look at the fire. A little over 1 million acres burned in the Labor Day fires. Just under 600,000 of those acres were federal lands. Private industrial was 276,000 acres. Small woodlands lost almost 100,000 acres of land in the Labor Day fires, which is why we're talking about casualty losses today. The county and others lost about just under 9,000 acres. So there's 1 million acres burned up. About 60%, a little over 60% was federal and state, and 40% basically was private. Okay, so let's look now about these special rules for the taxation of timber. We're on page now 6 of the outline. So one of the biggest tax breaks, if we want to call it a tax break for forestry, is this first one we're going to talk about here, which is 263A. Under 263A, basically, if you have so if you're a farmer and you're raising grapes, the grapevines, you plant the grapevines, and it takes 4 years before you get your first harvest of grapes. For that first period of time, the same thing is true with hazelnuts. It's about 4 to 5 years before you get your first crop of hazelnuts. All the costs that go into those vines or those trees have to be capitalized. None of them can be deducted. And that's because of 263A, which requires the capitalization of those costs. Forestry, which is timber raised, harvested, or grown, including Christmas trees, are excluded from those uniform capitalization rules, which means that we're allowed to deduct those costs, even though we have this asset that is a 60-year, productive cycle. So even though this is a long-lived asset, by not having a 263A apply to timber, that means that we can deduct those costs as we're going along if we're operating as a trader business. If we're operating as an investor, then many of those costs would be capitalized, but we're not required to capitalize them. So that's the first big special tax provision for timber. The next one is getting capital gains when we sell the timber. So there's a couple of code sections. So the first one is code section 1221. 1221 describes capital assets. So these are things like your stocks, your bonds, any capital asset that you have that you get long-term capital gain for it when you sell it. So 1221 says timber is a capital asset. So that's the standing timber, if it's not held primarily for sale to customers in the ordinary course of a trader business. And so if you're an investor or you just have trees on your property that you're holding them, as long as it's not held for the purpose of your sale to customers, then it's considered a capital asset. Again, this is the standing timber. So when we say timber, it always means a standing timber or the stumpage. But cut logs are not a 1221 asset. So it's just the timber that's a capital asset. If we cut the trees and we sell the logs, they're not a capital asset anymore. And so that is a challenge that we have in the tax code. So normally when we sell a capital asset, it gets just reported on Schedule D. The same thing is true here when we sell timber. We report those sales on Schedule D if we're an investor. And we get to deduct against that sale our cost basis. We call our depletable cost basis in the timber. So if we inherited the timber, if we purchased it, it was given to us by a gift, we would generally have some cost basis in the timber, just like if we purchased stock in General Motors. You buy the stock at $10 and it goes up to $12 and you sell it. You don't pay taxes on the whole 12, you just pay taxes on the gain, the difference between what you paid for it, what you sold it for. So the same thing is true with timber. We only pay the taxes on the difference between what we bought it for and what we sold it for. And so, but we report that on the Schedule D. We report the full sale price of the timber, and then we deduct our cost basis. We'll talk more about both how it gets reported and the depletion when we get to that part of the session. So that's reporting income and deducting expenses. We'll be talking about this in more detail. Section 1231 provides capital gains treatment if we're in business. So if we're holding these logs primarily for sale to customers, so we're in the business of raising timber for sale, then we don't use section 1221, we use section 1231. Now 1231 has some other requirements. So the first requirement 1231 is you have to have owned it for more than a year. It's 12 months and a day before we can apply section 1231. So if you bought something and you turn around and if you bought it and you're holding it for sale for customers and you sell it before the 12-month period, then there is no capital gain treatment because we're holding it for sale to customers. It's basically treated as inventory. If we don't hold it for at least 12 months and a day, we don't get capital gain treatment. So it's this property that's held for sale to customers in the ordinary course of business. But 1231 also includes property for which code section 631 applies. 631 applies to the sale of timber, coal, and domestic iron ore. So, and we'll talk about 631 in a minute. So the sale of 1231 assets, we don't report those directly on Schedule D. We have what's called the Form 4562, which is the, no, that's wrong. It's the Form 4797. I'm sorry. But anyway, there's a special form called the Sale of Business Assets that we report the sale on, and then the gains from that then go to Schedule D. So we have this reporting on the sale because of these business assets that get first reported on the form. It's actually Form 4797. So make a correction there. All right, so let's go to 631A. So 631A and 631B are kind of the heart of timber taxation. So 631A is when we use 631A whenever we sell logs and we want to get capital gain treatment. So this is an election that we make to treat the cutting of timber as a sale or exchange. And so we get to elect to treat these sale of logs as capital gain rather than ordinary income. So again, this is a 1231 deal, and so we have to have held the standing timber for more than a year. The sale of the logs is treated as ordinary income, and it gets reported generally on the Schedule C, which is the business schedule. Or if you're operating a farm, and we're doing the sale incidental to a farm purpose, we'll talk about that next time when we talk about classification. We can report it on Schedule F, but generally timber operations are considered not as agriculture, but as a business. So normally reported on Schedule C. So in the Schedule C, we report what we receive from the mill for the logs. The 1231A gain is the difference between the fair value of the timber as of the first day in the taxable year in which the timber is cut. So we're cutting logs, cutting timber throughout 2020. We would say by the end of the year, let's say we had 500,000 board feet of timber that we'd sold. We get a valuation of that 500,000 feet of timber, not all the timber, but just the 500,000 feet that we cut. And we value that as standing timber on January 1. So what was that timber worth on the stump on January 1 of 2020? So it's all the timber that was cut during the year. We value what the fair value of the timber while it was still standing on January 1. And in effect, we're treated as having sold that standing timber to ourselves. So in effect, we have two businesses. We've got one business that is raising timber. We have another business that's cutting and selling logs. And so the business that's raising the timber, in effect, sells its stumpage to the business that's cutting the logs, cutting and selling the logs. And so we have this, the capital gain is the fair value of all the timber that we cut during the year. It also shows up as a cost of goods sold on the Schedule C. So on the Schedule C, we report the sale of the logs, we report, and then we deduct from that the fair value of the timber on the first day of the year, and then all of our logging and hauling and all of our other operating costs during the year to come down to our profit from on the Schedule C. But then on the 4797, where we have the sale of the timber, we report again that fair value over on that form as a sale of business asset, and from that we deduct our cost basis in the timber. So we deduct our depletable cost basis in the timber on that form. Even if we're an investor and we're selling logs, we can use the 1231, the 631A provisions. When we do that, in effect, we're electing to bring 1231 into play. And so if we are an investor and we're selling logs, then we fill out a Schedule C or Schedule F to report the logs, and then we put the sale on the business form. Timber under the 631A definition includes evergreen trees, which are more than 6 years old at the time severed from the roots and are sold for ornamental purposes. So it includes Christmas trees, but only Christmas trees that are cut. So if we have somebody that's selling live Christmas trees, they dig the root ball up and sell the live trees, they don't qualify for 631A treatment. They actually have to be severed from the root, so it's a cut tree that gets the 631A provision. 631B is when we're selling standing timber. And we said, so the 1221, when we're looking at investor, we sell standing timber, we get capital gain treatment. But if you're in business and you sell the standing timber, the IRS basically deems it as you sold your inventory, and you don't get capital gain treatment unless we use 631B. And so again, we do the 631B, we report it on the form 4797 as a sale of business property. And again, so as long as we've held it for more than a year, we sell that standing timber. And we don't have anything on Schedule C in this case. We just report the sale of the standing timber on the 4797 minus our depletion. We don't have logging and hauling costs because we've sold it on the stump, and the person who's bought the timber is going to come in and put in the road and cut the tree and put it on a truck and haul it to the mill. And so we've sold it while it's still standing. If you sell the timber and you get paid before it's cut, you can choose to treat that payment date as the date of disposal, or you can actually wait until the timber is cut if you've retained an economic interest. So if there's some clawback provision, so if you sell it, you get the money, but if they don't harvest it, or if you don't get as much, if they don't have as much timber as they thought they would, that there's some amount that goes back to the buyer, then you can choose the logging date to pay the taxes. But if you just get paid up front, and if the timber burns down the next day, the burden of loss is shifted to the buyer, and there's no, they don't have any recourse to you, then the earnings process is completed when you receive the money, and that's when you report the gain. So report it when you get the money. Reforestation costs. This is another big deal here for timber. So timber, any amount that we spend in connection with planting timber, including planting Christmas trees, has to be capitalized. So that's this regulation I've got up here, Reg 1.661. So it basically says if we're any money we spend for reforestation has to be capitalized, and that includes the site preparation, includes the cost of seedlings, and any other required stand establishment costs. So whatever the costs we have to establish the forest. We're lucky here in Oregon, we actually have a definition for stand establishment, which is 200 trees per acre free to grow within 5 years. So all the costs that we have to establish a stand of timber are considered reforestation costs. And absent anything else, those costs basically get capitalized into what we call a plantation account. And those costs stay in that plantation account until you make your first commercial entry into the stand, at which point then they can be used for depletion. So we can't take those reforestation costs and use them immediately for depletion for your other timber. They actually stay locked up in that stand of timber until you actually go in and have your first commercial entry. That's a pretty punitive result because that first commercial entry is probably 20 years after you've done your planting. And so it might be 20, 25 years. And so that's a long time for your money to be locked up and not be able to deduct it. So the Congress allows us two choices. And again, this has to be elected on a timely filed tax return. The first election is Code Section 194A. So we have to make this election on a tax return, on the tax return for the year in which you do the reforestation, have the reforestation costs. And that allows you to amortize those costs over a 7-year period, 84 months. So we take a half a year's amortization in the first year. We take 6 years of amortization, and we take a half year in the 8th tax year. So it actually takes 8 years to get all your money back. So we can amortize those costs over an 84-month period with a half-year convention, which means the amortization starts on July 1. So that's the first one. So we can elect to amortize those costs over an 84-month period. We also have, in addition, another code section, 194B, which allows us to deduct in the current year up to $10,000 of reforestation expenditures per qualified timber property. We're going to talk about qualified timber property in a later session, but basically a qualified timber property is how you maintain your depletion. So it can be for all of your properties. It can be just for properties in one county or another. It can be based on each individual property. You can actually even subdivide your property into various blocks of timber that you keep track of separately. It basically just depends on how detailed records you want to keep for depletion purposes. And based on that, that's what we'd also do for your reforestation. It means you have to track everything, your harvests and your costs and everything by whatever blocks you have. So per qualified timber property, per block, we can deduct up to $10,000 reforestation expenditures for each block. So, and we can do both. So let's say you have a large harvest, so we've had people, say you lost, 100 acres, and it cost you, $40,000 to prepare the site and plant the trees. So, and that's one qualified timber property. So you have $40,000 of cost. You can elect 194B to deduct 10,000 of that cost this year, if you spent the money this year, and the other $30,000 then would be amortized over 84 months. And so we look at the total amount of cost. You can deduct up to $10,000 in the first year, and you amortize the other and the remainder over the 84 months. If you don't, and so the 194A and B, there's some disclosure requirements you have to put on the tax return. It's actually an election that you have to make. We make that election on a Form T, or you can put it in a statement. You have to include also how many acres were treated, what your costs were, and kind of detail them out. And so there is some disclosure requirements that go along with this election to make it. What's the risk if you just deduct those costs? Well, if you just deduct them and you get caught, then they basically become non-deductible. They get added to your reforestation account, and you have to wait until you make your first commercial entry into the stand in order to, and you won't get all your costs at that point. It's going to be based on how much timber you remove. So it's going to be part of your depletion in your timber. We put all these things together on a Form T. So the Form T is required to be attached to the tax return if you claim a deduction for depletion, if you make a 631A election, or you do an outright timber sale under 631B. So that's what it says on the form, unless you're only making occasional sales of timber. So if you got 1 or 2 sales every five years or so, you don't have to file the Form T. But if you're coming to every year or every other year with a timber sale, then they want to have the Form T. Now, whether or not you actually file it, you're required to have all the information in your files that the Form T asks for. And so the Form T, I find, is a great way to kind of organize your records, both permanent records and otherwise. So there's 5 parts to the Form T. You only have to fill out the parts that apply to you in the particular year. I do have a copy of the current Form T in the materials that I sent out to you. It's behind page 10 in the outline. And so the first part is the acquisition. So whenever you acquire timberland, either through purchase or through gift or inheritance, this is basically where you document your cost basis. Where you bought it and how you're allocating your costs between the land, the timber, your reforestation, any improvements on the property. So this is where you basically report what you paid for it, or what the cost basis was that you inherited it at, and how the cost basis was allocated to all the various components of value. Very important schedule. It's really helpful if you have this filled out and put in your permanent records. The second part 2, is timber depletion. So this is, again, I find this extremely helpful because this is where you can keep track going forward of your cost basis in each of your timber stands, depending on how detailed you want your accounting to be. So this is where you account for your cost basis and you actually make the depletion computation. So the depletion computation is right on this form to determine how much cost you can apply against the sale of your timber. The bottom of part 2 is actually where you make the 631A election. So question 18A, are you elected or have you made an election in prior year to treat the cutting of timber as a sale or exchange under 631A? And you say yes, and that's how you make the election. Once you make the election, it's binding on all future years. So whenever you sell logs going forward, if you've made the 631A election, then you just continue to report it that way. But they do want to know that you have made the election, even if you've made it before. You can revoke the election one time. And so many of the corporations, when they lost the ability, so corporations don't have capital gain treatment. A C corporation does not have basically capital gains were repealed for them. And so they revoke, any C corporation that held timber revoked their 631A election, so they didn't have to bother with the appraisals and all that because it made no difference for them tax-wise. But for all of us, the 631A election is a very important election and it's very helpful for us. Part 3 is profit or loss from land and timber sales. I find this to be relatively useless. I don't know why they ask this information in this way. Basically, what they want you to report is what you received in total for the timber, for the timberland, and then your cost basis. But this number doesn't go anywhere, and so I don't generally use part 3 very much. But part 4 we use a lot. So this is the reforestation and timber stand activities. So this is where you report your reforestation expenses. So you talk about, here's the block or the stand. You identify all the different types of things that you did. You in the number of acres. So you did site prep and replanting of 50 acres and the total cost. And then right there down below on 4A and 4B, you say, here's how much we're making the election to do the $10,000 per qualified timber property. And 4B, this is the amount we're going to amortize. So under 194A, B, 94A and B. So this is where you do the 194A and B election right on the part 4. If you don't attach this to the return, then in effect you have to attach a statement that has all this information on it. Part 5, it just shows changes in the land ownership. I find generally only the big commercial timber companies use Part 5. We generally don't have a lot of activity that occurs. We're not buying and selling timberland all the time. And so Part 5 it doesn't get used. All right. So that's kind of an overview of timber taxation. Again, we'll look at all these items in more detail as we go through the webinar. But we want to finish up today talking about casualty losses. So as we all know, we had this huge fire, burned up a little over 1 million acres. Starting the 2017 Tax Cuts and Jobs Act basically limited casualty loss deductions to federally declared disasters. And so we have to have a federally declared disaster before we can deduct a casualty loss. So in this case, Clackamas, Douglas, Jackson, Klamath, Lane, Lincoln, Lynn, and Marion counties, there was a federal disaster declared for the Labor Day fire for both fire damage and wind damage. I've got the number up there. We actually, when you fill it out, you have to include the FEMA number. So it's DR-4562-OR. So that is the federally declared disaster number. That number has to show up on the form when you claim the disaster loss. So what is the disaster loss? So the amount that you can deduct is the lesser of the decline in the fair value or your cost basis in the timber. So we look at the decline in fair value. So let's say the stand was worth $1 million before, and after it's only worth $200,000, then we have a decline in value of $800,000. So we compare that number to your cost basis in the entire stand, however you keep your tax records. And so let's say your cost basis in that entire stand was only $400,000. Then your casualty loss is limited to the lesser of those two numbers. So the first thing I do when I talk to people about casualty losses is to look at what is your cost basis, because that generally is going to be the limiting factor for most people. So if you don't have a big cost basis, or you don't have any cost basis at all on your timber, then you're not going to get a casualty loss. And so you take the smaller, and then you take the smaller of those two numbers, and from that you deduct any of your salvage proceeds. So we're out busily cutting timber now and trying to salvage the stuff before it rots. And so those salvage proceeds have to be deducted, and it's only the amount that we lost after we deduct the salvage proceeds from it that is actually the deductible casualty loss. So the reimbursement, so let's say you had houses burned up, because this doesn't happen just as timber. So many people lost their homes, they lost barns, they lost outbuildings and shops, other things. And so we look at the cost basis in those. We have the reduction in fair value or the cost basis, whichever is smaller, minus any insurance proceeds and salvage proceeds that we receive. If the insurance proceeds and the salvage proceeds are more than the cost basis, then we actually have a gain, and it's taxable. Now, insurance proceeds, because this is an involuntary conversion, you can use those and as long as they get reinvested in the property, then you don't have a taxable gain that you have to pay taxes on, but you have to reinvest the money. So what are the steps? So the first step is we determine what our depletable cost basis is in the timber, in that qualified timber property. And we determine if that number is big enough to justify the cost of the appraisals, because this decline in fair value has to be done by appraisal. And in fact, we attach copies of the appraisals to the tax return. This is a real challenge. I know I'm working with a client right now that is trying to get an appraiser to do this work, and they're just all completely booked up. They're really having a hard time finding them, and when you do find them, they're asking a lot of money to do the work, and so because they're just jammed up. So if we determine we have a big enough cost basis to justify getting the appraisals done, Then we get an appraisal, actually two appraisals. One is the value of the timber immediately before the fire, and one is the fair value of the timber that was remaining after the fire. So basically what they're doing is they're looking at what's left after the fire and then estimating what was there before the fire by looking at the stumps and other things on the ground. So we obtain that appraisal. So we appraise the decline in the value that was the result of the fire. So let's look at an example. So let's say, again, we have this $400,000 basis in the stand of timber, and that's in the timber, not in the land. Then we look at the fair value of the timber before the fire and the fair value of the remaining timber after the fire. So we had so at $400,000 of basis. We had $1 million fair value of the stand. It was worth only $200,000 after the fire, and so we had an $800,000 reduction in value. We look at the smaller of those two numbers. The smaller of those two numbers is $400,000. That's our cost basis. We had $100,000 of salvage proceeds. We deduct that from the $400,000 basis, and we would have then a $300,000 deductible casualty loss. So that's how the numbers work. So we look at the cost basis, the decline in value. From the smaller of those two numbers, we deduct whatever salvage we received, and then we get a deductible cost basis, or the amount of our deduction. So we have to wait until the 2020, we have to wait to file the 2020 return, because this is a 2020 loss. We have to get all of our salvage proceeds in before we can file. So even if those salvage proceeds come in 2021, they get basically taken back against the loss. And so, so we can extend your return clear up until October 15. If you're still doing salvage logging after October 15, you basically just have to estimate how much proceeds you think you're going to get in after that, and then you file the return. And if the number is significantly different, then you actually have to go back and amend the return once you get all the information. So we can do an estimate, but it's best to get as close a number as we can, because if you foul up on the estimate and you end up getting more money than you thought you would, then you're going to have income. You're going to have to go back and amend that original return. You're going to have underpayment and all that, and penalties and interest. You know, if you overestimate your salvage proceeds, then you go back and you can claim an additional loss. Again, if the salvage proceeds exceed your cost basis, you're going to have a gain in a taxable gain. It will be, again, it's called an involuntary conversion. So you have 2 years to reinvest those salvage proceeds, so you don't actually have to pay tax if they exceed your cost basis. I know this is true especially for buildings. For outbuildings, we probably have completely depreciated the outbuildings, and so our cost basis is generally lower than the amount of insurance or money that we get back. And so if that happens, as long as you reinvest all of your proceeds within that 2-year period, then you don't pay taxes. This all gets reported on the Form 4684, the casualty and theft form. So if it is considered business property, so if you have been claiming this as a business, and we'll talk about that when we talk about classification, but if you've been deducting your expenses and treating this as a business going forward, then the casualty loss gets reported as a capital loss on the Form 4797. Capital losses, we can deduct the extent of our capital gains plus $3,000. And so, so let's say we have that $300,000 casualty loss, and let's say we didn't have any capital gains in 2020, then we could deduct 3,000 of that 300,000 in 2020. You carry forward the other 297,000 until it's used up. And again, any capital gains that you have get applied against that capital loss carry forward until it's gone. And we can deduct, again, $3,000 a year in excess of our gains. So that's if it's business property. If it's a personal property for investment property, then it gets reported as an itemized deduction on Schedule A. So it's an ordinary deduction, but it goes on Schedule A, and if the Schedule A deduction is bigger than our income for the year, whatever is left, whatever is excess is lost. And so we can only deduct, basically, we can only bring our income to zero based on the itemized deductions. So we can, if you had a bigger income year in 2019 than you did in 2020, you can elect to report that loss back on your 2019 return by amending your 2019 return. So that's another option. So again, the casualty loss, there's some work to do. It's some expense because you do have to do the appraisal. You have to get a qualified appraisal, which gets attached to the return. And the loss can't exceed basically your cost basis. And then any salvage proceeds you get will reduce the amount of loss that you experience. You can deduct. And with that, questions and comments. I've got my contact information up on the screen there. So if you have some comments you want to direct to me individually or afterwards, feel free to do that. I think my contact information is also on the handout that you received, and I will turn it back to the group. So Mike, maybe you can do the sharing, and we can look at questions and do questions and answers.
Great work, Clint. We did receive a good handful of questions, and then even I got a couple in my email as well. So
great.
We'll just start from the top. Scott and Melody Munger ask, is it possible to get a copy of the graphs?
Of the presentation? Yes, we can make that available on the website.
Great. And I think that some of the graphs that you used came from OFRI.
Right.
So we'll link to those publications as well.
Yeah, the graphs all came from OFRI.
Awesome. So David Mendenhall asks, is there an acceptable method of determining the value of the tree at the beginning of the year if a cruise was not done at the beginning of the year?
Yes. So this is so the whole 631A thing, and we'll talk about this more when we get into the recognizing income, but it's a valuation exercise. And so we're looking at what the value is. And so there's also a, we'll talk about, there's a kind of a cost benefit amount. So, if the total sale is under, $40,000, $50,000, I think you take your best guess. And I mean, if you're off by a couple $1,000s, the tax difference is not going to be enough where IRS is going to worry about it. But if it's a larger sale, so if the sale is bigger than $50,000, you're probably going to want to have a consulting forester or somebody give you a number. I mean, you can do some of the work. You can do the work yourself. You can call around to the different companies, see what log prices were back then, at the first of the year, and then you have to deduct, a reasonable amount for logging and hauling and profit. Again, it's selling the timber on the stump, not the cut logs. And so the good news is generally January 1 is kind of the high point for the year in prices. It's not true every year, but generally because of supply and demand, there's not a whole lot of logging that's happening in the middle of the winter. And so that's generally kind of a high point in prices. And so generally a lot of times that stumpage value at the beginning of the year will be close actually to the delivered log price, in the middle of the summer when we're selling our logs. So, but it is a valuation exercise, and we'll talk about some kind of practical ways to look at that when we look at recognizing income in that session.
Great. All right. Jerry Lackner asks, if you sold a piece of property with standing timber, would you show the timber as a separate sale on a 631B?
No. If you're selling the land and the timber together, it's all just considered part of the real property. It's just one thing. So, and again, we'll talk about that more in recognizing income, but in the recognizing income section. But no, The standing timber in Oregon is considered realty. If you sell it along with the real estate, you don't have to call it out separately.
Great. I got a two-parter here, or sort of two-parter. John Westall and Kathy Farnsworth ask, ice damage of young stands, say 10 to 20 years old, reduces the future value of the stand, while the current value of the timber isn't changed all that much, fairly low both before and after the damage. Is the ice storm damage likely to be a causality loss?
So the casualty losses, we have to have a federal declared disaster in order to deduct the casualty loss. And so right now the ice storm has not been declared as a federal disaster. So even if the ice took your timber to the ground, wiped out a whole stand, there would be nothing to deduct unless the president declares it as a disaster. And so that's the challenge. We actually have 3 declared disasters in Oregon for 2020. I've got that in your materials. So there was a mudslide up in Umatilla County that was declared a federal disaster. And the COVID-19 pandemic actually was declared a federal disaster, but it doesn't, and that covers the whole state. But it was only basically declared a federal disaster for purposes of allowing federal aid to flow in to business owners and stuff who had losses. So we can't take casualty losses for COVID-19, which I don't know. I guess we can say maybe the riots or whatever, but anyway, for COVID-19 there wasn't a whole lot of property damage. But in Oregon for 2020, the only losses that are deductible are for the Labor Day fires for those specific counties.
So Clint, to build on that for a minute, because I want some clarification for everybody, because we are talking, the ice storm came up a couple times. The federal disaster declaration, can you clarify whether that's for personal use property or business property? Because I know there was some distinctions made in some of those changes.
Yeah, so as long as it's a federally declared disaster, you can have a casualty loss, whether it's a personal asset or whether it's a business asset. The difference is how it's deducted. If it's a business asset, it's deducted as a capital loss on the Form 4797. If it's a personal, and any excess basically gets carried over. If it's a personal one, it's treated as an itemized deduction for the current year only. So that's the distinction is how and where you deduct it. It doesn't matter if it's a business asset or personal asset, though, in terms of being able to, and the computation is the same for both. It's the lesser of fair value or the decline in fair value or cost basis minus any insurance or salvage proceeds. But again, the limitation, this is new. This before 2017, anybody who had a loss, so if we had an ice storm loss back in 2015, you could have claimed a casualty loss deduction. I mean, you would have looked at the value of the timber, the standing timber, even though the value would have been less because now you got the tops knocked out. And so the value of the stand would be less after the ice storm than before. And you would have been able to deduct that prior to 2017. But with the tax law change in 2017, we have to have a federally declared disaster before we can have a deduction, take a deduction.
Great. Keep it on the same while we're talking about unless you want to say something, Tammy, sorry.
No.
Oh, okay. John Westall asks a follow-up, is there any provision for incorporating reduction in future value in a casualty loss? If the ice damage is not declared a federal disaster, maybe it won't be considered at all and the question is moot.
Yeah, so the question I think is moot unless we get a federally declared disaster. But the reduction, when we look to the valuation, we do look at what the future, the value of the timber has declined because it's been impaired, right? And so I think if you look at the value of a stand where all the tops are knocked out, the value of that stand is going to be a lot less. Even if it's just kind of reproduction timber, the value is going to be a lot less. In fact, it may be close to zero because it's never going to turn into lumber. I mean, all right. And so by appraisal, I mean, as long as a cruiser would come in and say, yeah, this timber, because we can look, it's not just the value on this day, but it is the value mean, that's how you value reproduction, right? You value it based on what your expected return is over the life cycle of the trees. And so you do have a loss. It's just right now not going to be deductible unless the president declares it as a disaster.
Clint, did you mention the limitation when it's personal property on casualty? The $100.
Yeah, so there's a couple limitations. There's a $100 and there's another $500 limitation. It's complex. If you have a casualty loss, you don't want to do your own taxes. I guess that's the issue. There are a whole bunch. I mean, even the form itself is very, very difficult to follow. That's why I didn't go through deep. What I wanted to do was educate you on how it works and to encourage you then to go to, because you're going to need to take this information to your tax professional, and probably you're going to have to extend your tax return, which your tax professional is going to be very happy to do this year because of all the changes. They're having a hard enough time getting the tax returns done by April 15 this year.
So Jeremy, I don't want to lose this one that I've got running in the chat. Was regarding the Reforestation Incentive, Clint, and you didn't get exactly into the different types of organizations that qualify for the different pieces, but could you talk about who's eligible for the deduction versus the amortization, and specifically if a different on the trusts, whether it being revocable trust makes any difference?
Yeah, and again, we'll talk about this more in the next section and when we talk about deductions, but trusts, that irrevocable trusts, are not eligible for the deduction. A revocable living trust is not a problem because a revocable living trust is disregarded for income tax purposes. So if you own the property in a revocable living trust, but if you actually have to file a trust tax return and the income and expenses are on the return, so it's a irrevocable trust. Irrevocable trust can't take the 194B $10,000 deduction. They have to amortize the full amount of the loss or of the reforestation amount. Now, if you're married filing separately, each spouse gets a $5,000 deduction, or $10,000 if they file jointly, or even a single individual, if they own it, they get a $10,000 deduction.
Great, thank you. That's, I think, exactly what we needed to kind of clarify there.
Corporations, S corporations, partnerships all get the $10,000 deduction. The only one that does not is a trust that files a trust tax return, an irrevocable trust.
Great. I have another one in here. It says, I'm just a homeowner, 3 acres with Doug Fir. Not sure how this information relates to me. I use the insurance to pay the house mortgage off. Do we have to file for capital gains?
So did they have a fire? They lost the house, or?
I have no detail.
Yeah. So if you basically have a 3-acre parcel with some trees on it, actually you'll want to stick around in this session for at least the next 2 sessions because we're going to talk about classification and then we're going to talk about income. So if you ever sell any of those trees, this will mean something to you. If you don't ever sell the trees, then it's probably not important because those trees are going to be considered part of your personal residence, and any expenses that you have maintaining them are not going to be deductible.
Great. We got a couple other more specific questions, kind of moving away from the disaster work, but someone asks, does a qualified appraisal have to be performed by a licensed appraiser?
Yes. So, and for timber, basically it's somebody with a consulting forestry, consulting forester, somebody who's in the business of doing timber appraisals. So in order to get a qualified appraisal, now you can do the work yourself, and it's not a qualified appraisal. There are some parts in the code that require qualified appraisal. There's other ones that strongly encourage it, but you can do your own. Basically, I see a qualified appraisal as buying an insurance policy. You're having somebody that's not you saying this is the value. I mean, you have for yourself, the IRS looks at you and says, okay, you've got an inherent, they basically, you're not independent, right? So you're gonna, you have a desire to move the value up or down to make your tax situation work the best. And that's why we have a qualified appraiser who's independent from you, coming in and giving you the value. And so by doing the qualified appraisal, even if it's not required, you're basically buying insurance from the IRS. If they ever attack, if they're going to attack the value, you can say, well, this person over here who's licensed to do this work said that this is the number, and that shifts the burden of proof to the IRS. They have to prove that your number is wrong. Versus if you don't have a qualified appraisal, they can put whatever number they want on there, and then it's the burden of proof is on you to prove that they're not wrong. So that's the advantage of having the qualified appraisal. You move the burden of proof on the number over to the IRS.
Great. All right. Nicole Wood asks, how does one go about obtaining a proper basis for tax info?
We will discuss that in some detail in a later session. But basically, you're doing an allocation of either the purchase price. So generally, you buy it, you're looking at the relative fair value of the timber, the land, and all the other components of value on the property. It's generally done through some sort of appraisal process. If you get it through an inheritance and estate, hopefully the estate did that work for you. If it's acquired by gift, hopefully the person who made the gift to you also did that through appraisal, some sort of appraisal process. Generally, the challenge is when you buy it yourself, then you generally you have to go do the appraisal process yourself. You don't have to get a qualified appraisal to do this. You can do it yourself, but it has to be reasonable. Reasonable allocation is what the IRS asks for, and we're going to talk about how that is done when we talk about, I think, the expenses section. We're going to be talking about depletion and how you compute it and how you allocate basis.
Great. A few more here. Sarah Johnson asks, you mentioned that some of the tax provisions were different if it was a corporation. Is it assumed that we are all not operating as a corporation for tax purposes? In other words, if we are a corporation, does some of this not apply to us?
Yes, and we'll talk about that next time when we talk about classifications. So we'll look at all the different types of entities and then look at, based on that, for the most part, these provisions are the same. The only a C corporation, a regular corporation, doesn't have capital gain treatment. Pretty much all the other types of entities, these rules basically apply to the same for the entity as they do for the individual. And so it's really more dependent on the classification of whether you're an investor or in business or it's just a personal asset. Those are more important really than the entity issues.
Great. Jerry asks, if you sold a piece of property that had burned timber you didn't salvage, could you take a casualty loss?
So if you sold the property after the fire, yes, but the amount that you received that was allocated of the purchase price that was allocated to that burned timber or whatever timber was remaining, no, for the burned timber would be would be treated as proceeds. So you still have a loss. Before the fire, the property was worth this. After the fire, it's worth this. You sell the property. So you'd still have a casualty loss because those values changed, assuming you had a cost basis. So the computation would be the same even if you disposed of the property.
Sort of similar question. If you cut the damage logs around a fire storm building, is the cut wood still considered personal property?
So if you cut it and sell it, that would be salvage. So the value that you received from that cut wood, after you deduct the cost for cutting it, any net amount that you got, that would reduce your your casualty loss. But if you don't have a casualty loss, any trees that you cut down and sell, that's income to you. And it doesn't matter if it happened before or after the fire. You sell the timber and it's going to be taxable income to you. You're gonna have to report it and and report your costs and if you have your basis. So any sale, it doesn't matter why you did the sale, you have this issue. Now we have the situation where the sale, we'll talk about this again when we do talk about recognizing income. We'll talk about involuntary conversion. So the fact that it burned and you had to cut it and do that, you've got a little bit longer period of time maybe before you have to recognize the income if you are going to take that money and reinvest it back into the property.
Great. Bonnie Marshall asks, could you touch base again on the involuntary conversion? What kinds of things would be considered for reinvesting proceeds? Would road building / repair done during fire salvage count as reinvesting?
Yeah, my understanding on the reinvestment is that any reinvestment back into the timber property would qualify. So obviously the reforestation part, if you had roads that were destroyed, you're rebuilding roads. So in fact, you could acquire new timberland with the salvage proceeds, and that would be considered reinvestment. So so it's a pretty broad definition for reinvestment. It's just basically you're reinvesting the money into the forestry operation.
Great. And then I think this is our last question from Annabelle Morgan. Definitely a little bit different. Can we pressure the Oregon senators and reps to declare a federal disaster for ice damage from the ice storms?
Absolutely. Yes, yeah, especially here in Oregon, we have a pretty strong congressional delegation and a senatorial delegation, and and we have a president in the same party. So yeah, absolutely. You write them and say, we have this loss, and could you talk to the White House and see if we can't get a disaster area declared. It doesn't take much for them to do it. There's hundreds of federally declared disasters every year, and so we just have to get on the list. So I don't think it's a huge issue. It just has to get done.
Well, outstanding. I did get some other questions. It looks like we have a few more minutes, so this is coming from my email. Kevin Maloney asks, we are considering placing our 100 acres of forest land in Josephine County into an AB trust. We are not certain that is the best choice, i.e. is an LLC typically preferable?
Wow, that's probably outside the scope of today. This fall, we are going to be having, we're going to be doing another session, a series of webinars on estate and succession planning. And so, so stay tuned. That's a great question, and it's not easily answered. I don't know that there's not a right or wrong answer. The question is, what are you trying to accomplish? And so, so yeah, stay tuned for that. We're going to have a lot of fun talking about estate and succession planning. We thought we'd do the income tax seminar first, and then come back with the estate and succession planning seminar a little bit later this year.
Great. And this email did go to you too, Clint, so he's got a bunch of questions for you, but I'll ask one more that I think everyone might want to know. If I thin or remove diseased trees and sell for firewood, how is that income reported?
So firewood sales are also, they're reported on, generally on Schedule C. So again, it's income. The question is, and we're going to talk about recognizing income again later, but generally, if you're operating this as a business, you're just going to report it on Schedule C along with your other businesses. If you're not operating this as a business and you have your firewood income and it's just occasional, so this one time, and it's the only time you did it, you cut some trees and you sold a little bit of firewood, that doesn't rise to the level of a trade or business. You still report the income, the income gets reported on the front page of your tax return, but you may or may not be able to deduct any expenses. And so when we talk about next time about classification, and then the time after that about recognizing income, we'll kind of tease that out a little bit more. So, but yes, anytime you sell something and you get money, generally it shows up on your tax return. And the question is where, and can you deduct expenses, and is it self-employment income, and all those are kind of the universal questions that goes around it. But whether or not it is income, generally if you get money for doing something, it is income and you have to pay taxes on it. That's the general rule.
Awesome. Well, I don't have any other questions. Do you have any closing comments from either of you? And then I've got a little bit of a wrap up.
No, great. So thank you everybody for coming today. I hope you enjoyed it as much as I did. We're going to have a lot of fun over these next 6 sessions. And you know, I'm an accountant. You know, we have this brain damage. I really love this stuff. And so hopefully I can share some of the joy of tax planning with all of you. But more importantly, to try, you know, again, to introduce you to the concepts so you can have an intelligent conversation with your tax preparer. I also would encourage you to invite your tax preparer to these sessions, and maybe Jeremy, you'll talk a little bit about the resources we're going to make available on the OSWA website for the tax professional community.
Yeah, outstanding. Thank you, Clint. First of all, thanks everyone for attending. I saw at one point nearly 80 participants joining in, which is outstanding. I will comment that if you have registered for this meeting today, or this webinar today, you are registered for all 7 episodes. You'll receive an email in advance. I believe it's usually the day before with the Zoom login information. It'll be the exact same format. Clint and Tammy will be taking your questions. And as you can see, Mike put on the screen the next 4, March 23rd, next Tuesday. These are mostly these are all on Tuesdays at 3 p.m. They are not every week. So pay attention a little bit to which specific Tuesdays there are. In addition to that, these are being recorded. So if you had to leave early, or you know someone who missed it and wants to pick up and get another session in, or you want to refer back to something that Clint or Tammy said, Dr. Cushing said, then please, we will have that available on the OSWA website, probably by the end of the week, if not before the next Tuesday session. We will have this one complete and uploaded to our YouTube channel. If you watch our social media or the front page of our website, it will go there as well. But my plan is to develop a short tax page dedicated to all the materials from this series, as well as the videos. So there's one-stop shop for all the details for forestry taxation for small landowners. And then I have to make this other pitch. If you are not an Oregon Small Woodlands Association member, OSWA members contribute, and by paying their membership dues to make events like this happen. So if you are a member and you paid your dues, thank you. If you're not a member and you want to know more, please check out oswa.org. That's all I have. Thank you.